Imagine there is what is called as an inventory opening of 100 units. I am not talking about amount out here. Then there is a closing inventory of about 75 units. There is a material utilization of about 1500 units. How many units have you bought? No, you calculate, numbers are very clear here. 1500 is the units you have utilized, right? That means ideally you should have bought it. 100 units were already lying in stock. That means how many you would have bought it? Only 1400. But at the end of the time, at the end of the, what do you call it as your manufacturing, 75 units are still left. That means how many units have you bought? 1475. Apply the same principle there. Treat both independently. That is why I did not mix both. Even when you said creditors, I said no. Creditors is separate, inventory. Let us go step by step. This part of it, right? Now, you might say this entire 100,000 now I will say, no, that means how much of material you utilize? You have utilized about 1475 units of material out there. Now, there is what is called as opening creditors about 150 and closing creditors about 250. 1475 is the material that you have basically purchased this particular year. Am I with you? That is what we calculated as of now. 1500 is what you have utilized, 100 is there in the stock. That means 1400 is what you should have ideally bought, but 75 is still there at the closing stock. Ideally you should have bought 1475. Am I with you on that? Yes, sir.
So the inventory opening is like each product.
No, in this case, let us keep it as raw material or whatever. Let us keep it as let us not. We have not split that. We can split it into 3 parts. Finished goods inventory or 4 parts. Inventory which is in transit, raw material inventory, work in progress. 31st of March, your car is getting manufactured on assembly line. There can be only halfway, right? It could be. So let us not get to that level of granularity as of now. Let us keep it as simple as possible. So 1475 is the amount of material that I bought actually. Now I go to the next aspect. You bought 1475 units of material. Imagine I have last opening creditors, I had to pay for 150 units of material last year. That means what is the total eligible liability to pay this year? 1475 is what I have bought this year plus last year's 150 I have to pay. That means it will be 1575 plus 25, that is 1625 is the kind of for number of units for which I have to pay. Am I with you on this? 250 I am yet to pay. 1625 minus your 250. That is all what I did, right? Take simple numbers, easier. 100, 200, 1890, 1960 will always be a problem. My dear, you forgot or it was clarified? Both can happen. You're still thinking. Thinking about what? Sir, I'm going to re-explain this. Don't worry. We are not moving ahead until you guys get this right. We are not moving ahead until you are getting this right, right? If I move ahead, then I'm losing the class. Let's keep it simple. Sir, don't worry about INR, rupees or dollars or whatever. Worry about only units. I utilized for production this year 100,500 units. Am I with you? Which point? Same thing, it's just instead of units you put INR, yeah. It's all. See, again, for the benefit, taking one more minute. Don't worry, if it's repetitive for you, just relax mentally relax for a minute, no problem. 1500 units is the material that I have utilized this year. And I see, in the beginning of this year, there was 100 units of material which was lying in my godown. How many units of material I should have ideally bought? That means, if I utilize 1500, 1500 minus 100, I should have ideally bought 1400 units, I should have ideally bought out there. Am I right, Abdul? Now, but at the end of the period, I also see 75 units of material still lying in my godown. That means, sir, it could be from this 100, it need not be from this 100, let's not worry about all that. So ideally then, how much you should have bought? 1400 is what you have bought, taking only this and this into account. and you still see 75 lying in the godown, that means ideally you should have bought 1475 units of material. Am I with you on this? So far clear? No problem. 2017 sir, 1st of Jan. I am going to make it clumsy again, no problem. 31st of December 2017. This is Jan to December 2017. Now dates are clear. How much have you utilized during the year Jan to December 2017? 1500 units. Ideally you should have bought those units. But on 1st of January 2017, how many units were there in your godown? 100. That means how many units you would have bought? You should have ideally bought for 1400 you should have bought. But at the end of on 31st of December, you still see 75 units lying in your godown. Ideally how much you should have bought? See, imagine I take these 100 units and I utilized, I have bought 1400, I have taken this 100 and then utilized 1500 out there. Totally 5 sheets out here. This is your opening inventory, keep it with you. One sheet is your opening inventory, there are 3 sheets which you are basically utilizing for production, right, that is 3 sheets I have utilized for production out there, that is what I have basically see in this particular case. That is what you say in this particular case, 3 sheets I have utilized for production, or for example this one sheet is your closing inventory, let us take. Now even I have used these 3 sheets for my production activity out there, these 3 sheets could include some sheet which was there as an opening inventory also. He gave me out of these 3, he gave me 2 sheets which was opening inventory. Ideally how much I should have bought then? Only 1 sheet I should have bought. But I also see 1 sheet with him as a closing inventory, then how many sheets I would have bought? Simple, very simple sir, it's all. Now till that point it is very clear, 1475 is clear. Now let us come to this opening and closing creditors. 1st of January, my creditors were 2017 1st of January, I am sorry I had to make it very clumsy, I couldn't help it. Now and for opening creditors was 150. That means in this case how much have you bought? Are you clear, Abdul? 1475 is what you have bought out there. Out of 1475 you have bought, that means you ideally have to pay for 1475, yes or no? How much was due at the beginning of this particular year? 150. So that means it is 1575. Are you following? Yeah. So you should have ideally paid 1475 plus this. But you are yet to pay another 250. So how much have you ideally paid? 1475 plus 150 minus your 250 is what you would have ideally paid out there. Am I with you on this, sir? So far so clear. So just take that and then move here in this particular case out here what we have calculated. I am sorry bored you for 5 minutes, but I need to take as many people as possible along. So now just extend that, that was in units, this is in INR, just do that, extend it. So you will know what is the cash outflow occurring because of a cost of sale that has basically occurred out there. Am I with you on this? So far so clear? Okay. Next. My cash outflow also can occur because of an administrative activity, 910. If there is a no cash outflow, then it would be there in the, if there is no, if for example administrative expenditure I have not paid, it is still due, then where will it appear? That is all, very clear. So if there is there anything due on administrative expenditure in the liability side? Smita, anything? Nothing? So then naturally ideally what has happened? You have basically paid it as cash. So there is a cash outflow of $910 out there because of a operating activity. So if I look at that, I have sales which is a cash inflow, you arrived at something around 30,150. My COGS or my purchases, my cash outflow is because of 26,690. Then another cash outflow that has happened because of admin activity is another 910 out there. Am I with you? Is there any other item pertaining to operations out here? Now that is the beautiful aspect out here. Now tell me, that is sales. 1 second, sir. I will just write that for 30,000. Sorry, 150 net. And what do you call it as COGS is negative 26,690, admin negative 910. Yep. Is there any item, any other aspect pertaining to operations out there? Depreciation, somebody said. Who said depreciation, sir? Anshuman? So what are we calculating? What are we calculating? Cash outflow. Sir, don't worry about illusions. Illusions is over from the last class. Yesterday illusions are over. P&L is over. Today we are talking about hard currency. When you are talking about hard currency, depreciation, no cash outflow, no effect on your cash at all. You would have said, sir, I bought the machinery for 3 years back. 3 years back it would have had an effect, not today. Am I with you on this? So no effect on that. Then any other aspect? Insurance proceeds that is received. Interest expense is what? When you pay interest? Huh? We are talking only operations. We are doing, no, inflow also, right? Cash sales is an inflow, no? Inflow and outflow, both. We are doing, one sec. We are doing only for operations. The other are two aspects, I will come to it before 10:40 today, definitely. Yeah. Now two aspects out there. What I said is true, doctor. One is insurance out there. In this particular case, you see that you have received money of about $140 on insurance. Normally, unless otherwise specified, I am receiving insurance for an investment loss that occurred. Unless until that is specified, insurance receipt is normally more treated with regard to your what a claim with regard to your loss on your operations out there. Same way, similarly, taxes. You would say taxes, what happens? I would say I pay taxes on dividends also, on the receipt. I pay taxes on my investment interest what I earn also, perfectly fine. But predominantly taxes are what? Taxes for your money generated from your core activity in the business. Core activity is the operations out there. So let us keep taxes a little aside. We will come to taxes in a minute. I will say insurance proceeds. $140 out there. Treating it as operation unless until otherwise clearly specified, sir. If it is specified, don't worry about it. Now coming to taxes. What is that? What will P&L statement say? P&L statement will tell you what is the tax paid or what is the tax due, what is the tax for the year. What is the tax for the year? Will it give you what is the tax paid? Will it give you what is the tax due, or will it give you what is the tax for the particular year? For the particular year, that's all. What is the tax for the particular year? $300? $300. Now is it a cash outflow, madam? Is that a cash outflow? Yes? Sure? How much is the cash outflow? Go back to your balance sheet. Look up on the liabilities. Was there anything due last year? Is there anything due this year? For example, 300 might be taxes for the year. You might not have paid anything. There is no cash outflow in that case. In this particular case, if you look at, you see that tax. Payable last year. Wait. Let's calculate what is the total outflow. What is the total eligible liable to pay? 1,000 plus what is the due last year? This year 400. Stop it there. Now that means last year there was still a due tax payable of 1,000 which was there. This year's tax which appears in the P&L is only tax pertaining to this particular year. It will not talk about last previous years. This year it is 400. So what is the total tax you ought to pay as of this year? Cash outflow that ought to occur, it will be about 1,400 is the cash outflow that ought to occur. Wait. Ought to occur.
300 is the current.
Oh, I'm sorry. 300 is the current year. I'm sorry. Look at the P&L. P&L. What is the tax for the current year? Tax for the current year is $300. What are the due last year? 1000. So what is the total cash outflow that need to occur? The cash outflow that need to occur or you are liable to pay. Let me look at that you are liable to pay is 1300. But you also see in the balance sheet in the current year 400 out of that is still due. That means how much you would have ideally paid? 1300 minus 400, that is about 900 is what you would have ideally paid out there. But there is one small catch out there. You see that, go to the additional information out here. Point number 1, 2, 3, 4, fourth aspect out here. The tax deducted at source on dividends received included expense of included the expense of 300 for the year amounted to rupees 40. Out of the 300 for the year, what you have written as tax, 40 rupees pertains to dividend. Dividend tax is not part of your operating activity. So how much is part of your operating activity? 900 minus that 40, 860 should be the part of your operating activity. There is a cash outflow of 40 which has occurred, but that is because of a dividend, which is basically what is called as dividend you have received. Dividend you have received is basically investing activity out there. So let us not worry. So ideal tax outflow should be basically what you call it as 860 minus. I repeat, sir, I repeat out here. What is the tax for the year? 300. Go back and read point number 4, additional information. It says you have received dividend. On that dividend, what you have received, a tax of $40 was deducted already. And then the tax which was deducted also pertains to you, because instead of you paying, he is paying TDS, what you typically call it as. That is also included in the 300. That means how much is the tax from operations for this particular year? Only 260. Agreed? Fine. You had to pay last year $1000. So what is the tax liability as of this year? 1000 plus 260, 1260 is the total tax liability as of this particular year. You are yet to pay 400 at the end of the year. So what is the tax you have paid? 860. That is what I have taken care out here. Agreed? Anything else on operations? Any other aspect of operations? That's all right. One second, sir. 1830, right? Yeah, taxes. 1260 minus 400 is the amount you would have paid. If you do that, that is nothing but 860. This is what is the cash flow that is there from your operating activity. From core operating activity, this is the kind of cash that is being generated. This is the kind of cash that is being generated. That is what I said, cash flow. CF is cash flow from operations. That is the kind of money that is coming in from operations. What is put in braces is basically that is only for accumulated depreciation and as well as your cost of sale. Normally negative figure. Negative means anything money going out is always in braces. That is, instead of putting minus, we put it in braces out there. Am I with you on this so far? Yes, doctor. So far so clear, sir. Operations. Now what have we done? There are basically what we have tried to do is we have taken the P&L, we have taken the balance sheet, we have tried to see what is the cash that is coming in from the operation, what is the cash that is getting out of the operations out there. That's all what we have done so far. Operating activity alone. With you on this? Clear? Now I move to the next aspect. Now let us get to what is called as next, what is it? Investing or financing? Investing. Next let us get to your investing activity. Now let us get to your investing activity. What has happened to first investing activity? Investing activity is what?
Previous one. Insurance 140 rupees. Insurance we claim.
Insurance you have received, not claimed. You have received. That is what it says. Extraordinary item. It says, it reads as extraordinary item. Insurance proceeds from disaster management. Proceeds means it has come in. Money has come in. Receipt out there. Insurance, when a fire accident is extraordinary, you know, and when you receive money on that, it's extraordinary. That's all. It's a very, very simple on that. See, it is an activity which is not ordinary is extraordinary. It's basically what happens, any of these one time activity which basically occurs, not a regular activity. That's all. Unexpected, one time activity, normally extraordinary item out there. Suddenly you have a lot of land, you decide to sell all your piece of land, parcel of land out there, and you make a profit, extraordinary, right? It's not a day to day activity out there. With you on this? Now I move to cash flow from what is called as investing activity. Where is investing? This one or this one? No, that is at operations. Just look at it and tell me. It's my own writing, I can't make out. Now I look at the aspects out there, give me the problem set, that's fine for me. Let us look at it from the P&L activity. Investment income, there is an income which you have received from your investments out there. There is an income which you have received from investments out there. Which one? Okay, leave it there. Now when you have received an income from investment, that is obviously a cash inflow because of an investing activity, accepted. Now is there any pertaining aspect in the balance sheet? Investment income which is due last year, due current year, let us look at the balance sheet and then see, it should always be an asset out there. There is what you call it as interest receivable, there is what is called as interest receivable. Last year was 0, this year is 100, that means this year interest income that has accrued for me is investment income that is accrued for me is how much? $300. How much have you received this year? Only 200, because 100 is still due this particular year, straight on the investment or investment income. Then we'll come to the market, hold it sir, marketable securities, hold it, marketable securities and cash alone, hold it, 1035 definitely. Then next aspect, you receive income on the investments, there is something called as dividend income, interest income you are receiving if it is a debt, if it's a investment in some kind of a, what you call interest bearing security. Dividend income if you are receiving, you are because you have invested in some equities out there. There is a dividend income also which is to the extent of to the tune of about $200 in the P&L, and there is nothing due last year, nothing due this year, there is no item mentioned in the balance sheet itself as far as dividend income is concerned. Am I with you on this? That means ideally you should have received that money, dividend income. So far so good? No? We will come to that. One second sir, one second. But have you received this entire 200? Go back to item number 4. $40 is paid as TDS, that is basically on the investment that you have basically made out there, that is what is called as tax on dividend minus $40. Investment?
First line 300.
Why 300? Why 300? Now look at your, what other investment activity is there, you just take a look at it, what other investment activity is there? I think P&L we have almost covered everything barring interest expenditure. What other investment activity is there? 2500 what? Huh? Which one sir? Where is sir? Where is it sir? Balance sheet, what is there sir? Investments. That what is the investment last year? What is the investment this year? So is there a cash inflow or outflow? Then why are you worried? Supposing that had increased, then whatever is the amount of increase obviously will be a cash outflow. Supposing that had reduced and you have received the proceeds, whatever that has reduced will be your cash inflow. In this case it has not changed. Swapnika's question is, it could be that you have sold something and bought something, fine, you can add minus 200, you have sold minus 2500, you have sold all the investment, you have bought for all the new investment plus 2500, add it, no problem. Now when we say investment need not be only the second aspect of the balance sheet, asset side of the balance sheet. Balance sheet, if you look at the flow, fixed assets, investments, current assets, then miscellaneous expenditure and losses. It is not only the second aspect. Wherever you are investing money, you might have invested money in buying a machinery, you might have invested money in buying a car out there. That is also what is called as investment. Anywhere you have invested money, anywhere you have put in money out there is all what we call it as investments out there. Let us look at the fixed assets in this particular case. If you look at the fixed assets out there, last year was 1910. Don't look at the depreciated value, look at the gross value. Look at the gross value. Don't look at the depreciated value, look at the gross value. Depreciation, keep it aside. In this particular case, let us look at fixed costs, fixed asset. Gross value. Gross value indicates what? The value at which this asset has been procured. Gross value was 1910. Net value, gross value current year is 2180. Last year was 1910, this year was 2180. Ideally, what should have happened? You have purchased some more fixed asset. What is the value of the asset that you would have ideally purchased? 2180 minus 1910, that will be $270 is the kind of asset that you would have purchased. Don't write 270 as of now, hold it for a minute. Just go out to point number 1, 2, 3, 4, 5. 5 and 6. During the year, the enterprise acquired property and plant to the extent of $350. Cash was paid out there. When you have acquired plant and machinery for $350, cash was outflow is $350. Read the next aspect. Plant and machinery costing $80 was sold for $20, that apart. So, the gross value we are worried only about $80, we are not worried about $20. How did it increase only by $270? Because you have bought a machinery for $350. So, ideally it is 1910 plus 350 minus $80 value, gross value, that is the value you have sold. So, 350 minus your $80 is your $270. That is what you basically see out there. Am I with you or not? So, basically what is the cash outflow because of a purchase of machinery? Cash outflow because of purchase of machinery is $350. We read that point. Am I with you on this? You have paid cash. Then what does it say? It also says that you have sold some machinery which was at $80 for $20. Sir, that selling that $80 machinery at $20 is a loss profit. Don't worry about loss profit here. What is the cash inflow that has occurred? What is the cash inflow that has occurred? $20. That is sale of a machinery. Am I with you? That's all.